Closing costs are fees you pay when you close on your home. If you're taking out a mortgage, these fees are paid at the time of closing and can run from about 3 to 6% of your loan amount, though your closing costs may vary. When we bought our first home, for instance, our closing costs were just under 2% of our loan.
It's important to know what these costs are so that you can be prepared. Unlike your down payment, closing costs do not translate into equity or ownership interest in your home, so getting these costs as low as possible will be important.
What types of closing costs might you have to pay as a home buyer? Loan origination fees. These are administrative fees that your mortgage lender charges. Origination costs can include processing fees and underwriting fees, typically 0.5% to 1% of the loan amount. Underwriting is a step in the loan approval process when the lender determines whether you'll be able to repay your loan based on a variety of factors, including your credit history.
Your mortgage lender will require an appraiser to determine the value of the home. This is to make sure that they are not lending you more money than what the property is worth. This allows the lender to recoup all of their money in the event of a foreclosure. An appraisal typically costs $300 to $500.
Credit report. Yes, believe it or not, your lender might charge you a fee to run your own credit. The fee varies, but it's typically $10 to $100 for each person applying for the loan.
Flood certification fees. Is your home in a flood zone? This is important for the lender to know so that they can account for any additional risk. Fees to look up flood determination from FEMA is typically $15 to $25. If the home is in a flood zone, the lender may require the buyer to take out flood insurance.
Title exam fees. The title shows ownership of a property. Title exam fees are costs involved in examining the current title to ensure the people selling the home are indeed the correct sellers and all owners are who they say they are.
Title insurance. Although the home title is closely examined during the process, things sometimes get overlooked. Title insurance policies can help protect you and the lender from a variety of issues that might be uncovered down the road. There are two types, one for the lender and one for the buyer. Your mortgage lender will usually require title insurance that protects the amount they're lending. But since that policy only covers the lender's losses, buyers may want to consider buying their own protection. Policies range in cost from $150 to more than $1,000.
Attorney fees. Some states require you to hire an attorney to review the sale and draw up paperwork. Attorney costs vary significantly, so you may want to shop around to find the best deal.
Recording fees. These are the fees paid to record your deed and mortgage with the local government or authorities, and typically run at least $100.
Prepaid interest. When taking out a mortgage, you will typically have to pay in advance for any loan interest between the closing date and the last day of that month. Closing as close as possible to the last day of the month could help you cut down on these costs.
Escrow. This is an account that the lender might establish to hold reserves and to pay your insurance and taxes. We put our property taxes in escrow. For example, when closing on your home, the lender will usually take 6 months worth of property taxes up front.
Homeowner's insurance. The average cost of homeowner's insurance is around $1,200, but can vary significantly based on location and the specifics of the property. Typically, you'll have to pay 1 year's worth of premiums up front.
Private mortgage insurance. If your down payment is under 20%, you may need to pay PMI, which helps protect the lender against any losses if you can't repay your home loan.
Mortgage points. These are also known as discount points. This is money you could pay to your lender upfront in exchange for a lower mortgage interest rate. A point is 1% of your loan amount. The more points you pay upfront, the more the lender will lower your interest rate. How much each point lowers the rate varies among lenders. This saves you money the longer you own the house.
You might have to reimburse the seller on a prorated basis for any expenses that they've already paid. This can include things like homeowners association fees and property taxes.
Hopefully with this information, you can go into your closing meeting a bit more prepared and feeling excited to purchase your new home. Thanks for watching.